earth, when I'm trying to build financial independence, when I want to be beholden to an insurance company, I have to borrow money from myself. And the only way that I kind of win in that scenario is if I die, right? Like if I die before the money runs out, or I got to start putting money back into it. I think a lot of people, because they're complicated and they're difficult to understand, it's just putting this black box of, this is what wealthy folks do. I don't know that I would agree with that.
Today I'm going to be reacting to the Money Guy show. They have a segment on their show where someone asks them questions, and the question was brought up on should I invest in life insurance, and they have a 7-minute response. I agree with a ton of statements that they make, which will make this interesting. This BetterWealth React, very interesting because I'm a fan of life insurance when set up and used properly, but I am an anti fan when it's not set up, used properly, when it's sold to the wrong type of people, and when it's oversold using sales language. Like, it makes me so angry. And you're going to see a lot of reasons why life insurance has a bad rap. In full disclosure, I'm a big fan of the Money Guy show. Brian and Bo, I actually met them 2 years ago. Incredible humans. I don't agree with all the things that they say. And I think you can find how amazing it can be to interact and react to content and not just throw someone under the bus. I actually, again, agree with a lot of things that they say, but there's some things that I don't. And my hope is to give my raw reaction throughout this. And so without further ado, let's jump in.
Okay, we have a question from Mohit. A financial advisor suggested that I invest in a quote-unquote investment engine with death benefits.
I hate that. Like, invest in a quote-unquote investment with a death benefit. That's like salesy. And I wish no one would use that language. Isn't that bad that the client has to do digging to figure out what this is?
Instead of a backdoor Roth IRA.
What could that be?
I did some digging and it appears this is an indexed universal life insurance.
By the way, you wonder why I take such a hard approach against most IUL. It's because of this. It's because it's so much easier to scam people because you can say all the talking points and as a result, mislead people. That's not true for everything, of course, but if you look at a lot of people that are aggressively selling life insurance the wrong way, it's way easier to sell index universal life because of these talking points than whole life. Hence, why majority of what we do is whole life, because we're not selling it as an investment at all. We're like 10 seconds in and I'm getting fired up.
Is this a good idea?
So Mohit has run into someone who said, hey, I've got this great solution for you. Instead of investing in a Roth IRA, those stinky old things, let's put you in something where you can mimic the market, but when you die, there's still a benefit for you.
And a lot of times people say it's better than the market. You'll beat the market because you have no downside. You don't take any downside, but you get upside.
Life insurance policy, something like that.
It's an equity.
Index universal life.
Ratchet it up without the risk.
So I don't want to speak. I'm going to speak sort of vaguely, right? There are tons of products that are wrapped inside of insurance-based products where you have some sort of investment component. And we've done countless shows on the ins and outs of those, how they work, I'm going to give you sort of the Bo Hansen big overview of what I don't like about it. I don't like when you combine financial products, because I think when you start combining them, neither of them can do the thing that they're supposed to do really, really well. So when you combine, like life insurance is supposed to be there when you die. So what do I want when I buy life insurance? I want the maximum amount of money to go to my family at the lowest cost to me while I'm living. That's what I want. What do I want with my investments? I want the maximum amount of growth over the longest time period possible. When we end up putting those together, what you get is
And I 100% agree. And you might say, Caleb, aren't you a huge fan of like cash flow banking? You have a book called The And Asset where you teach people how to save their money and use it throughout their life. But I never once will say that insurance will be investments. I'll never say invest in your life insurance. I'll never say that life insurance should replace investments. And so that is really, really key. It's like when someone's saying we're going to take the insurance and we're going to combine it into investment, marrying it together, and we're going to get out, amazing returns. Absolutely not. Like, it's a bet. Like, you will be disappointed that you do this. And a lot of people are selling insurance as like the rich man's Roth for those same reasons.
Subpar solution on both fronts. You get really, really expensive life insurance and really, really expensive, poor performing investments. So I am of the opinion, let your insurance be insurance and let your investments be investments.
Another way to say that is buy term and invest the difference.
And in my experience, when we do that, we often find ourselves in a better position. We do the things like buy term and invest the difference or whatever the thing may be. I really love doing it that way. You agree, disagree, think it's more nuanced than that?
No, I mean, this is, here's something that I think is, I'll do a little story time.
Everybody buckle up.
No, it won't be that long, because there was, back when we were in Georgia, there was a Chick-fil-A that it was a Truett's, because it had a counter service. There was a let's just call him an insurance representative who would hang out on the Truett's and basically just befriend anybody who walked in. And we got somebody came in through our doors that was a widow, that a recent widow, and she had gotten a hold of this person, and he loaded her up in 2 of these equity index type products. On the brochure, here's why these things sell so well. I'm just going to share this. You have to do your own due diligence on it. They tell you they can get what the stock market does without the risk, because they don't, on the years the markets are down, it's like a ratchet. It doesn't go down, it just ratchets up only. That they'll even use that in the sales brochure. Which
is not even true, but you do get some of the upside and you limit some of the downside investment risk. There's still cost of insurance, there's still commission. So it's like, if you actually look at the policy, if you're not hitting the upside, a lot of times your policy is getting worse and worse off. And in a lot of cases, it could be some of the reasons why you have really lagging results. You might not get the downside risk, but it will translate into negative things for your cash value and for your goals.
And fortunately, these things have so much issue that they actually have a period that you can return them and get your money back. Fortunately, I mean, this is you got
a little bit of a red flag right there.
You ought to have to know that anything that has a look back period probably means that there's a high sales force, that the government has stepped in and said, yeah, okay, we're going to let you have this sales force do it, but there's going to be a look back where you can't surrender it, and it'll be like it didn't happen.
In all fairness, even term insurance has a free look. All kinds of insurance has free look. So that might be because of like the strong sales nature, but also it's because to lock in insurability, to say, hey, get this life insurance now, and make sure that the moment you walk out of the office, if you sign this, like, you're going to be able to be protected. And so it allows people to protect themselves and still have time to read over all the paperwork. So I'm in agreement that there's reasons like that you may want to look at your free look, but it's not just for like index universal life. It's across insurance, all across the board. And so that's just kind of like countering that talking point.
Here's what I don't like that they don't tell you in the sales brochure. Participation rate. They usually gut those returns. They'll cap you out somewhere between 7 to 9%.
So if the market has a 28% year,
and to be fair, some of them are higher, but the same point will be what they make.
You might make 7%.
A lot of your long-term compounding comes from those mega years. Those years where the market gets crushed and then it has its quick recovery and makes 20, 30%. If you're locked down at 7%, you can quickly see that you missed out on years worth of compounding. There's a reason they put that participation rate and limitation there. The other thing I don't like is, and this is where it hit this widow that I was dealing with, the surrender and back end fees were horrible, because there's a reason they can also offer a guarantee, because that's not something that's offered very easily in the financial world, is because that they lock your money up for 7 to 10 years typically.
And sometimes even more, but yeah.
They will give you access either in 5% or 10% increments per year. But if like this client had some medical things coming up, and you know, because they're a widow, a little bit older, and I was like, you realize you're gonna have to burst that policy just for your upcoming cash flow needs. I can't believe this insurance agent didn't. And believe me, when I called the home office to take this policy back, they got very embarrassed when I brought up all the reasons, because I did this call with the client at the time. That blows my mind, and I kind of fall back onto what Bo was talking about, is that I love insurance. I mean, because I think that there's definitely a time and a place for making sure that you're protecting yourself from catastrophic type things, whether it's disability, whether it's death. You do need to have coverage on that type of stuff, but that's different than investing. So
I agree.
You know, let's isolate those things, because I have found that most people, most things and products aren't good at everything. You know, let's find somebody. Let's get the best of the class on everything we do. I've told you how much we love index investing. I told you how much we love term life insurance, and we love buying disability. Why not go get industry leaders in each of those categories instead of getting something that's lukewarm, that probably isn't going to serve your purpose in a purposeful way, except for the person that sold it to you. I bet if you ask them how much they make off of it, if you saw the number, you might be a little surprised.
Can I just say one other thing? I know this question is going to go a little bit long, but maybe you have someone in your life saying something along the lines of, well, yeah, but wealthy people invest in insurance products. Wealthy people do that. This is a solution for wealthy people. Wealthy people. As two guys here who literally work with wealthy people for a living, it is true. a lot of wealthy folks do use insurance products as a means and a mechanism to serve a specific purpose. Maybe they have businesses or they have illiquid land, or there's some reason that they have an estate tax purpose. It is a very small percentage of folks that actually end up having to do that. Well, then you get this thought, oh, well, maybe these people, they build it up and they borrow from themselves. That right there is a premise of itself that I can't get over.
I do disagree with this. I'm going to let them finish and then address all these points.
Why on earth, when I'm trying to build financial independence, would I want to be beholden to an insurance company? I have to borrow money from myself, and the only way that I kind of win in that scenario is if I die, right? Like if I die before the money runs out, or I got to start putting money back into it. I think a lot of people, because they're complicated and they're difficult to understand, it's just putting this black box of, this is what wealthy folks do. I don't know that I would agree with that.
Yeah, I just, I know we'll take some flack because we do have some really good insurance people that follow us, and they'll be like, guys, I wish you wouldn't pick on. But I would just tell you, make sure that when you're doing the due diligence with your clients and your prospects, that you actually are doing what they need, because that's the big thing. I think if your business will flourish if people can tell you're not selling product, that you're actually trying to be a technician and giving people the guidance.
All right. So overall, big picture, I agree with 85% of what they're saying is, and the big theme is don't mix insurance and investments, and you're not going to get like a better insurance product and a better investment and put it together. Like, so the concept is if you just buy term and invest a difference is like temporary, insure yourself, your investments will outgrow, then your investments can self-insure and you can have the benefits and you kind of get best of both worlds. That's the concept. And it's true if you just look at net worth, but you also, the thing that you need to realize is like, what is the goal of what I'm trying to do? It's like, what's the goal in retirement? Future cash flow. And so we have to think, okay, the goal is future cash flow. So I want to optimize cash flow. And so again, I'm not saying that an insurance investment is the solution. I'm just saying that sometimes I would opt to have a lower portfolio if I could maximize income than a higher net worth portfolio if I couldn't. Obviously, we would all agree with that. And so I'm going to share some of the things, the pushback that I'll give them. I believe that 95% of people should not put money in permanent life insurance. I like smile in saying that because that might be shocking to many people, but majority of people are not sophisticated enough to do what I'm sharing with you. Now, if you're watching this video, you're probably in the 5%, or there's probably a good chance that you're probably more sophisticated so you can get these concepts. But for the most part, if I had to put my message on a billboard, I would be all about buy term and invest a difference, because majority of people should protect their families and they should invest. Like that, those are two things I'm a fan of. And if everyone did that, like I think the world would be far better. I mean, like the majority of people are not protecting their families and they're not investing. And so the whole concept of buy term and invest a difference, I'm not anti buy term and invest a difference. Now you might be like, well, Caleb, you wrote the book, The And Asset. You have hundreds of thousands of dollars into permanent life insurance. Why do you do that? Do you think life insurance is better than investment? The answer is no. I think insurance, number one, if set up and used properly, we're talking massive early liquidity, massive flexibility, 1/10 of the commission. We're talking about looking at life insurance as a contract, but maximizing the cash benefits and flexibility. And I don't look at it as an investment. I look at it as a superior place to store and use my money. So as an entrepreneur, I'm speaking to entrepreneurs that have this dilemma of should you invest for the future or hold on to money in a bank account. I'm saying insurance long-term will be better than storing your money in a bank account, right? It's better privacy, better tax benefits, better growth. There's a death benefit that's tied to it, but there's also other, living benefits that could benefit you throughout your life if you get sick and all that stuff. And what I'm saying is insurance is a better long-term place to store your money than a checking account or a savings account. So I think we're tracking. And then I'm also saying that insurance is not going to outperform investments. Your greatest investment is yourself, your business, your real estate, maybe the market. And so we teach our clients, if they're going to go down that route, is to borrow against. And you're not borrowing from yourself. That would be dumb. You're not borrowing from yourself or paying yourself back interest. You're borrowing against yourself to buy other assets. And this is allowing you to have two assets in your portfolio versus one. That I can share that concept. I have plenty of videos on my YouTube channel and have a book and all those things that can break that down. And I could say that still 95% of people should not do that. If you don't have at least $10,000 to initially start this, it's not even for you. So like I can say that this is a legit strategy. It's not, get rich quick. It's a place where you can protect and use your money, and majority of people shouldn't use that. And that's tough for me sometimes to have a message that 95% of people probably can't take advantage of because like they're just not sophisticated enough. And this is not a blow to, like, I guess it is. We're just not financially literate in this country. And when people like Dave Ramsey are saying, cut up your credit cards and all debt is bad and all these things, you could say, I disagree with him. But if I had a megaphone to the United States or to majority of people, I would agree with more than you think with Dave Ramsey, because I think most people are slaves to to their credit card. Their credit card is enabling them to make bad decisions. This is an example of why it's hard to have a message, but then I can't just play the team life insurance and say all people that are criticizing life insurance is bad. Like there's truths to both of these. Okay. So the big thing is that's where I'm a fan of life insurance. If people have money and they're like, hey, I want to control my cash and be able to use it, but I also want the long-term benefits of what life insurance could give me. The only other person that I think should consider having some permanent life insurance is people that have money in the market, maxing out their 401ks. They have their money and their whole goal is to grow up their assets and then retire, which is create future cash flow in the future. I think there's a lot of studies, whether you look at Ernst & Young, when you look at many people out there that are talking about retirement, I think a lot of people are saying life insurance can be a better, more superior, non-correlated bond. And so there's many people that are like, you need to diversify your portfolio because you don't want all your money in one stock or one indexes. And so there is a movement that's saying, hey, a portion of your quote unquote retirement portfolio should be in non-equities. And as a result, you'll have more stability as it relates to cash flow. What I'm saying is permanent life insurance, there may be a world where 10 or 20 or maybe 30% of your portfolio, depending on your goals and how much you have and your age, should be in permanent max funded life insurance. And as a result, it might give you different options. And I have other videos that talk about how life insurance and retirement can be used. Those are the two reasons. Never once will I say insurance is going to outperform investments or all your money should go in insurance. It's like, because it's a foundational and to understand you have to understand how it fits into other assets and a strategy. And again, I can't stress enough where you got to do this right, or you're going to look back and be really, really frustrated at yourself that you got sold a bill of goods that is a fraction of what it could be. Hence why I'm a big fan, again, of using whole life versus IUL that can look way better on paper, but we'll see what actually happens 10, 15, 20 years. And the reason I get a little bit like cautious whenever you're pitching something and you need that product to shine for it to work, I think you should eliminate the variables. And that's just my personal opinion. This is not insurance advice. It's not tax advice. It's not investment advice. This is Caleb reacting to a video and getting passionate about it. So let me know your thoughts. Let me know if there's other videos that I need to react to. And as always, really, really appreciate you allowing us to have this channel, because your attention, your views, your shares are the currency of what keeps this possible. And so with that, I hope you have an intentional rest of your day.